For more perspective on the timing and content of Groupon's IPO, let's turn to Bloomberg contributing editor and Infectious Greed blogger Paul Kedrosky, who joins us now from San Diego. Paul, you have been one of the biggest Groupon skeptics, to say the least. What's your take on these latest numbers? Do you see an improvement?
So, yeah, well, I mean, there's an improvement insofar as they've shown that if you cut marketing spend, they can deliver, kind of break even on an operating income. But I don't think that should have been a big surprise. Where there's an improvement, which is where I think this is going to turn into an IPO worth watching, even if I'm still very skeptical about the business, is on the valuation front. So say it comes in, $9 to $11 billion, something like this. At that valuation, floating something like, I think it's 5% of their shares, which is even less than than LinkedIn floated, this thing is going to be very difficult to not do well as an opening day trade. So what you're likely to see here is an awful lot of institutional interest in anticipation of a stock that does very well on the opening day, largely because of a small float and the optics of improved bottom line, even if the cause for that is something we should all be very nervous about, which is that they cut marketing spend and the business decelerated, rapidly.
Speaking of that, other Groupon skeptics out there aren't convinced either. I want to read a tweet from Rocky Agrawala, a blogger and a consultant, who said, Groupon did a great job of dressing up the pig for the state fair, but it's still a pig. Paul, do you agree with that?
He's very colorful.
A pig with lipstick, right?
Yeah, that's great. So I don't know. It's my issues. I mean, to be less colorful, my issues are really structural about the business. And the business has not shown that in the absence of marketing spend, that there is a real business here that doesn't consume prodigious amounts of capital as far out as you can see. And as a matter of fact, the little laboratory test we just ran, and we talked about it last week, was that if you shrink marketing spend at Groupon, what happens? No surprise, you get to on an operating income basis break even, but the business slugs into a wall. So does that make it a pig? I don't know if it makes it a pig, but I don't think it makes it a particular appealing long-term investment. It probably makes it an interesting IPO flip, but those are two very different issues, and that goes to the very heart of the problem here.
Hey, Paul, one of the things I noticed when I crunched through the numbers, there was one number that actually looked good, which is the amount of money spent on the average Groupon. Again, you got to tease those numbers out of the model, but I wonder what that says about the businesses they're going into. Maybe, I don't know, travel's doing well all of a sudden? Did you get any sense of that?
Yeah, I mean, I think that's part of it. I think they've got some new categories that are doing a little bit better, and I think, that's, I think that's something worth being somewhat optimistic about, and at least insofar as, anyone was skeptical that this was just a fad. I don't think couponing and on daily deal discounting is in any sense a fad. I think it's actually truly a platform business. The trouble is when you're as broad as Groupon is, you risk coupon fatigue, you risk getting into this problem of the marginal buyer of coupons doesn't spend as much as the hardcore discount coupon buyers did early on. So you're always fighting against a whole bunch of headwinds, and all of these headwinds show up in every mature couponing segment they have, and they're forced to continually prospect for new ones. And there are only so many categories like, say, travel that they can wander into. And again, this gets to the structural problem. You do not get to take your foot off the gas on marketing spend for long.
Now, we did a thing sort of previewing this a couple days ago. I said one of the things to look out for is how much insiders are going to sell. Well, in this filing, we see no plans for insider selling. That could change. But does that matter here? Does that suggest that these guys believe this thing is a better company than we might have thought?
Only if you weren't paying attention when all the insiders sold months ago. So absolutely, as long as your time horizon is the next 3 weeks, it's usually positive. If you open up your time horizon to include all the insiders selling earlier in the deal in private secondary rounds, then no. I mean, insiders have been selling all the way along, and that's been one of the issues with this stock. So that they're not selling on the IPO is optically entertaining, but frankly irrelevant in terms of the outlook for the business. And I think the deeper structural issue that as a long-term holder of Groupon, assuming there are such people out there, you need to worry about is this dual-class share structure that even though you're seeing some of the principles diluted down dramatically, you still end up with insiders controlling something like 58% of the shares through this, I think it's like 150 for one dual-class structure that Levkovsky, Mason, and others control. And so you really are still investing very much in these three principals who are running the company.
Paul, earlier on Bloomberg today, Scott Galloway of NYU said this is going to go down as the poster child for hysteria and excess. at this price with this many shares, how do you actually think this IPO is going to play out?
Recent history says this thing could easily go up 50%, and it wouldn't surprise me at all to see it do, 1.5 to 2x, within a week of the IPO. Wouldn't surprise me at all. But that's all technical stuff. That's driven by the incredible publicity this offering's got, the very, very small float on a high-profile offering that everyone feels like, oh, I know those guys. So there's huge retail interest. You'll see lots of open market orders on the IPO. All the dangerous stuff that we all, get worried about when this sort of thing happens. So this is an offering that could do very, very well. And then after that, all bets are off for all these structural reasons we're talking about.
Of course, it matters what happens in the long term, right? All right, Bloomberg contributing editor Paul Kedrosky, thanks for joining us there from San Diego.